This is Horizons Middle East and Africa. Our top stories this morning. Treasuries rally after private sector data signals a cooling U.S. labor market and bolsters bets on a Fed rate cut. Softbank in focus after selling its entire Nvidia stake for almost $6 billion to bankroll AI investments. And Iraqis vote in one of the most watched parliamentary elections in decades as the country looks to balance its relationship with the U.S. and Iran. We are live in Baghdad with more analysis. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in South Africa. I'm Jennifer Zabisaja in Johannesburg, in for Jumana Bersechi. Plenty to pay attention to as the markets are still trying to digest some of the activity that we did see on Tuesday. We were mentioning what we did hear from Softbank, that really triggering a broader sell-off in tech that we did see in U.S. equities. If we start with S&P futures, marginally up right now. What we did get on Tuesday, though, was perhaps something that we've been deprived of, which is some insight into the labor market in the U.S. The ADP report signaling a softer than expected labor market in the U.S., potentially then boosting more bets for Fed rate cuts. But also there's potentially some sentiment feeding in about optimism over the U.S. government shutdown coming to an end at some point. We will see the House, though, voting later on Wednesday, though what we were mentioning at the top of the show, Softbank really triggering a broader sell-off overnight in U.S. equities. And right now we actually are seeing Softbank down just over 3% there. If we take a look at cash markets, they are back open in the U.S. today after the Veterans Day holiday. That was on Tuesday. Right now we're seeing the U.S. 10-year yield marginally down right now, but still consolidating at about 4.0829 there. The dollar is also back in focus. We've been paying close attention to it as we continue to talk about this king dollar perspective. We're seeing the Bloomberg dollar index up again, edging higher for the first time in 6 sessions, rebounding after some of those losses that we saw initially from that ADP report on Tuesday. We are awaiting, though, potential commentary that we'll get from a number of Fed officials across the day on Wednesday, potentially offering some insight into what they think about this latest labor market report and also potentially what that means for the path ahead. And let's just finish on crude because we are awaiting a number of data releases as far as the oil markets go right now. Brent crude down just about nearly 0.3% there, but still a lot of what is in focus is this narrative about supply and demand, dynamics, and we will get a bit more insight into that in just a bit. Let's just bring you a quick look at our terminal chart for this morning, and that's digging into metals and some of the themes that we've been seeing in the metal sector. Right now, we're taking a closer look at aluminum and some of the other metals like copper joining the AI party, as we're seeing here, aluminum actually hitting the highest in about a year, as investors are increasingly looking to other parts of the AI trade and looking at the potential demand that we'll see for renewable energy and also data centers, that having an effect on some of the metals that we pay close attention to. Let's just bring you, though, some breaking news. We were talking about oil demand and the narrative around that. We are just getting a report from the IEA. They are reinstating their bullish oil demand growth scenario in a key report. Very interesting what we're hearing from the agency, a bit of a shift in tone, and what they're saying is a lot of this hinges on what they're seeing as potentially a slower pace of electric vehicle adoption. Not just that, we're also seeing a different White House tone as far as oil goes, and this administration, as the IEA states, both championing fossil fuels and also attacking renewable energy sources. Potentially that will have an effect on what we see long-term with demand. And the IEA further notes that its stance on imminent peak in oil demand is actually a bit tempered from what we've been hearing from the agency before. They do expect oil demand, or they did expect oil demand to plateau or fall in this decade, but now potentially, given a number of these effects that we're seeing with the White House and other parts of the globe, potentially that's looking different as far as the picture goes moving ahead. Let's check in, though, on how markets in Asia are faring. Min Min Lo is standing by in our Hong Kong studio for more. Min Min, what are you watching this morning?
Across Asian stocks here, as you said, the prospect of the end of the government shutdown, the repricing of those Fed rate cuts, providing a bit of a tailwind for Asian stocks here. You can see the Nikkei a little bit flat here. Of course, it's being weighed down by the Softbank story, which I'll get to in a little bit. But if you look at the topics, though, it's not on the screen, but the topics actually faring much better on the back of strong earnings from Japanese companies, including the likes of the automobiles, the precision equipment manufacturers, the banks also doing pretty well in the session today. Sony, of course, reported yesterday tremendous earnings there, and that stock is also on a tear. But we flip the board, we take a look at the slump in Softbank. It was off by as much as 10%. We're off some of the lows, now just down by about 4% or so. But Softbank dumping its entire stake of Nvidia, and that really brought to question a lot of, concern about whether that AI trade is over, right? But Softbank did say that they are dumping that stake in order to fund some of their AI investments into OpenAI, for instance, and that they still can't tell at this point whether there is indeed an AI bubble. So it's not meant to send a message that the bubble is building. But flip the board, we take a look at some of the movers in China. Of course, we have the end of Singles Day yesterday for most e-commerce platforms. Alibaba still continuing on with the sales until end of this week. But JD.com reported some of the numbers, very strong numbers, record sales. Xiaomi also seeing sales topping $4 billion, and these two stocks are gaining today. Alibaba, we don't have the numbers yet, and that rival of JD.com seeing a slide of about 3% here.
Thanks so much, Min Min Lo in Hong Kong for us. We'll check back in with you in just a bit. Now, Treasury yields across the curve slide lower after private sector jobs data from ADP reports a slowdown in the second half of October, signaling a cooling U.S. labor market. That's bolstered bets on a Fed interest rate cut in December, with money markets now pricing in a 70% chance of a reduction. For more, joining us is Charles-Henri Monchau, Bank's CIO. Charles-Henri, thank you so much for joining us. Let's just start here because we did finally get a bit of data and some insight into the labor market in the U.S. Does it change your expectation for what's potentially to come next as far as a market catalyst goes?
No, we are not that surprised to see some cooling data on the job market. Actually, looking at the alternative data, it's a kind of a mixed picture. The ADP one was indeed on the weak side, but we have seen last week other data which were firmer. So we think that the job market is definitely cooling down, but nothing, let's say, too serious. I think also the weakness on the bond yields this morning is coming from a private data on the inflation side. There was a release from Open Brands, which shows a meaningful drop in inflation in the US, mainly coming from rents. It seems that there is a very serious cooling down on the rent side with deflationary pressure coming. And as you know, it's 33% of the CPI basket. So, if you combine the job market data plus these private data on inflation, it seems that we are not, for the time being, going into these, let's say, heating up scenario of inflation, and that's probably a good thing for market to see bond yields, staying where they are.
Do you still expect, though, to get some insight into what we hear from Fed officials? We were mentioning their 70% chance. There still is some expectation of a December cut, 25 bips or potentially 50.
Yeah, well, I think the 25 basis points seems very, plausible. I'm also very interested to see what is going to happen on the balance sheet side. Remember, we heard that quantitative tightening is going to stop. And last week, the New York Fed president talks about the start of QE. If they stop quantitative tightening, that's the equivalent of another rate cut. And if they start QE, that's the equivalent of another rate cut. So I think that the Fed is probably going to balance between the number of rate cuts and also what they do on the balance sheets. On the balance sheet side, they need to act because we have seen the last few weeks some issues on the funding market. So I think they are very vigilant on that side. They want to avoid, a scenario similar to what we saw in 2019. So I'm not only looking at what they will do on the red side, but also I want really to focus on this balance sheet, which is very important for the market.
Well, and you also expect if we do see the end of the government shutdown that a wave of liquidity is to follow. Is that your expectation for today?
Yeah, I think this is indeed a very important, let's say, developments. We have seen the replenishing of the Treasury general accounts, which is now above $1 trillion. That has acted basically as an equivalent of a rate hike over the last few weeks. That's very mechanical based on the shutdown. If we see the end of the shutdown, that means that there is indeed a massive amount of liquidity which could be re-injected into the market, into the economy. That could be a bullish trigger for the end of the year. So all of the mechanics around this TGA are very important to monitor.
Charles-Henri, can we finish on a lot of this discussion around potentially an AI bubble that we are seeing and the concentration of markets really on the Mag 7 and tech? What is your feeling on where we're at right now?
So point number one, the Gen AI secular story is not over. Point number two, the story is broadening. You mentioned before, for instance, the metals. So it's not just other tech stocks which are benefiting from this AI story. It goes much broader than that. And metals are indeed reacting quite aggressively to this AI story. But point number three, we need to be vigilant in terms of concentration. I think that the Softbank move is interesting, but also there is the debt story. There was a JP Morgan report mentioning that it is expected that there will be $1.5 trillion a year of borrowing due to AI capex. 1.5 trillion is almost the amount that the Treasury is borrowing on a net basis every year. So that's massive, and that means that obviously, rising debt is not always something comfortable. These companies were before cash rich, let's say net debt negative, and now they're gonna sorry, net debt positive, and now they're gonna borrow much more money. We need to also monitor the credit spreads. Look at Oracle, for instance, the CDS, which keeps moving up. So there are new opportunities, but also new risk.
When do we start to see this broaden out, though, Charles? I mean, does it start to broaden out, as you were just alluding to there, in the metal space? And does it start to broaden out globally?
Yeah, well, we have seen also some move in China, but to give you an idea, an example, there is a small company in Italy called Prysmian. They were created back in 1876, and they were going nowhere. But as they are manufacturing electric cables, the stock is up almost 30% this year because there is high demand for electric cables. That's a very old Italian company, but they're also benefiting from the AI story. So I think it's not very visible in the numbers so far because the Mag 7 have been doing so well. But I think that's from a, let's say, macro and micro perspective, this AI story is indeed broadening much beyond what we could see, with the Mag 7. It's not just, let's say, a tech story. It's an industrial story. It's a power story. It's a metal story.
That's good news for a company starting in 1876. Charles-Henri Monchau, great to have you, a Bank's CIO. Thanks so much for joining us. Now for a look at some of the other stories that we are following this morning. Softbank stock fell after the tech investors announced it sold its entire Nvidia stake for $5.8 billion to fund its AI bets. The sale coincides with a growing debate about whether spending by big tech firms will produce commensurate returns, with investors questioning the amount of capital pouring into technology with uncertain returns. Softbank founder Masayoshi Son has been unwinding positions to pay for a plethora of AI projects, including Stargate data centers with OpenAI and Oracle. Allies of British Prime Minister Keir Starmer are trying to ward off a feared leadership challenge from Health Secretary Wes Streeting. Bloomberg has learned that Starmer's supporters are accusing Streeting of plotting to replace the Prime Minister, which they argue would risk a market shock and undermine the government's finances. A spokesperson for Streeting described the claims that the minister was after Starmer's job as, quote, categorically untrue. This comes just 2 weeks before the government is due to unveil a contentious budget. And U.S. President Donald Trump's aides have been reviewing federal funds that benefit New York to potentially suspend or cancel them. A White House official has told Bloomberg the administration is waiting on Trump to greenlight any funding freeze, but the official hasn't detailed any specific programs that could be on the chopping block if the president follows through on his threats. We're told the White House and the mayor-elect's transition team have not been in correspondence. Now, coming up, we look at what's at stake as Iraqis vote for a new parliament. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabisaja in Johannesburg. Iraqis voted in a parliamentary election yesterday marked by tight security and a boycott by a major political bloc. This election comes following major shifts in the region over the past 2 years, including the weakening of Iran's influence following the wars in Gaza and Lebanon, as well as the fall of Syrian President Bashar al-Assad last December. Joining me now is Lahib Higel, senior Iraq analyst at the International Crisis Group, joining us on the phone. Lahib, thank you so much for being with us. Let's just start here. Where does Iraq find itself in the midst of this current election, especially considering some of the dynamics and the changes that we've seen over the past 2 decades for the country and the past year for the region?
Good morning. Thanks for having me. Yeah, I mean, we always tend to say that Iraq is at a crossroads, and it seems to be around every election. This time around, it's actually one of those elections that have happened against a fairly stable situation where Iraq is the only country that has hosted resistance groups that actually hasn't been targeted by Israel, for instance, something which the government has taken pride in terms of being able to keep Iraq out of the regional escalation. The incumbent prime minister has, during this time, also managed to provide Iraqis with slightly better infrastructure, some tangible differences that Iraqis have been able to see, and that has spoken to his relative popularity in contrast to previous prime ministers. But having said all of that, domestically, Iraqis have also voted with their feet. Most of them didn't show up to the polls, and that is due to widespread disillusionment with the political system that has really been increasing for every election. And I don't think that this election is going to be a significant departure in terms of how the country has been governed over the last 2 decades.
Can you speak to some of that disillusionment and especially some of the proxies that are potentially at play in this election here?
Right. So, I mean, the problem is really with the entire political establishment. We very often talk about the Iran-backed groups, which pose a threat in and of themselves because of the arms that they control, but really the political system is rotten to its core. Corruption is widespread. It is not concentrated with a few groups, and I think that is what Iraqis are most disillusioned about, and why we've seen participation drop over time, because really that problem has increased. It hasn't really decreased. And even as Iraq has stabilized since the military defeat of ISIS, which is now 8 years ago, there isn't much that has been done in terms of reform. We don't have really a private sector that can take on the job provision that the state now provides. The economy is completely oil-based, or at least up to 90%. And the demographic pressure in Iraq is only increasing. So we're 45 million today. We're going to be 80 million by 2050. You already have a very high unemployment rate in Iraq. So that's only going to worsen. So I think that is a lot of what speaks to the the Iraqis not having trust in the political system, and that then we haven't even started to speak about the fact that armed groups are still running rogue in the country and very often able to act on their own devices.
So what then are you looking out for, Lahib, considering a lot of the confluence of issues sort of at play here? We just had up over 7,000 candidates here. Is it likely that the incumbent will be reelected? What should we be paying attention to?
Well, so strangely, Soudani is likely to come up top with the largest number of seats, but that is no guarantee for him winning a second term. And it's not because of him, it's because of also how the system is set up, whereby usually a compromise candidate is decided upon by the main political blocs. So let's say that Soudani actually manages to form the so-called largest bloc in parliament. That isn't the majority, but just the largest political bloc. His bloc is supposed to be able to put forward a candidate. Even in that case, it doesn't mean that he, as a person, would necessarily take the premiership. And that is because ever since Nouri al-Maliki, who's the only prime minister who's won a second term, there has been somewhat of a taboo in Iraq for two-term prime ministers, and that is because of the fear of people monopolizing the executive power.
Yeah, and also relations with the U.S. We weren't even able to get to, but quite a bit to pay attention to. Lahib, Higel, senior Iraq analyst at the International Crisis Group, joining us there to break down the Iraq elections. Thanks so much for your time. Now, coming up, the IMF is warning countries in Africa and beyond to tread carefully when considering swapping dollar loans from Chinese yuan to cut debt costs. We'll bring you the story next. This is Bloomberg. Let's take a quick check at where your markets are positioned. Quite a bit of green on the screen here. U.S. equity futures pointing higher right now. S&P futures up just over 0.1% there. Euro Stock 50 futures looking like a positive start for this Wednesday, up just about 0.2% there. Now, coming up, the IEA has reinstated its bullish crude forecast. We'll discuss that next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Treasuries rally after private sector data signals a cooling U.S. labor market and bolsters bets on Fed rate cuts. Softbank in focus after selling its entire Nvidia stake for almost $6 billion to bankroll AI investments. And Iraqis vote in one of the most watched parliamentary elections in decades as the country looks to balance its relationship with the U.S. and Iran. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg, in for Jumana Bersechi. And as we were just mentioning there, quite a bit of factors going on in the markets right now, notably that Softbank sale overnight. If we take a look at U.S. equity futures, they are pointing higher right now, though overnight we did see a bit of a sell-off for tech after we did get that news from Softbank, though we are seeing upside for U.S. equity futures, especially after that ADP report that we got on Tuesday, signaling perhaps a cooling labor market in the U.S., thus bolstering bets on Fed rate cuts to come potentially in December. Let's take a look at the U.S. 10-year yield. As we were mentioning, Treasuries are rallying. Cash markets are back open today. today after the Veterans Day holiday on Tuesday. And what we're seeing right now with the U.S. 10-year yield at about 4.0829 there. We are awaiting, though, the House to return back to Congress today to potentially vote on an end to the U.S. government shutdown. So perhaps we do see a bit of clarity on what this looks like next in the U.S. And we also will hear from some Fed officials later on Wednesday speaking. That brings me to the Bloomberg dollar index, up, edging higher for the first time in 6 sessions, rebounding after some of those losses that we did see after that initial ADP report right now. But still, quite a bit of focus on where the greenback goes next and what some of those drivers will be. Perhaps some of that Fed speak will provide some clarity. And we are focusing in on oil today. We did earlier this morning bring you that IEA latest report. Right now, Brent crude is down just over 0.3% there. And the IEA, as we were pointing out, offering a bit more of a bullish outlook on where oil goes next. Brent is trading at about $64.93 a barrel there. And a quick look at your terminal chart. We keep talking about the AI trade, and we were speaking with our guest earlier about perhaps we'll start to see this broadening out. Well, we are, in fact, seeing that to a certain extent, broadening out into metals, and in particular, aluminum hitting new highs, and other metals like copper also starting to join in on the AI party trade. That was a quote that I just put in there. But still, a lot of this focus is on really what the demand will look like for renewable energy and also data center capex. And so metals starting to gain a bit of recognition as it comes from the AI trade. Now, let's pivot to Asia markets. JD.com saying orders during this year's Singles Day shopping festival jumped nearly 60% from last year, including a surge in overseas sales. Let's bring in our China correspondent, Minmin Lo, for some details. So, Minmin, some positive signs from JD sales numbers. Walk us through what you're watching.
Yeah, indeed. Very positive signs. Was a bit surprising given the very deeply entrenched structural problems around deflation in China. But JD.com reporting record sales on year at this year's Singles Day. I think what we're not clear about is that they haven't given us a breakdown of exactly how much of that sales is coming from domestic market, because the very robust numbers that you see is largely being pushed by the overseas sales, right? We're talking about double of the sales in areas like Singapore, Malaysia, South Korea, Japan, Australia, and Thailand. They're talking about tripling of sales numbers in foreign markets where they provide free delivery, as well as 40% increase in shoppers. So that really helped to lift the overall numbers. As I said, not so clear what the domestic market numbers is really looking like. We're waiting for Alibaba's numbers because they haven't released that. They're still extending that sales until end of the week. But we do have Xiaomi's numbers reporting over $4 billion in sales. And this, again, coincides with what Alibaba had told us actually early on in the initial hours of the campaign. They did say that consumer electronics were among the top sellers, especially Apple's iPhone 17 and Xiaomi 17, the two competitors there, doing really well in this year's Singles Day. And also, bear in mind, competition is intense with that discount campaign, right? Alibaba allocating 50 billion yuan in consumer vouchers. That is the largest ever allocation to Singles Day so far.
Fascinating insights there. Thanks so much, Minmin Lo in Hong Kong for us. Great to have you on, Minmin, as always. Let's turn back to the energy story. The International Energy Agency has reinstated a scenario in which global consumption keeps growing to the middle of the century. While oil demand was set to plateau or fall this decade in the IEA's report last year, the agency now sees a scenario in which consumption rises 13% by 2050, driven by a slower pace of electric vehicle adoption. For more, joining us now is Hamzeh Al-Gaaod, MENA analyst at TS Lombard. Hamzeh, thanks so much for being with us this morning. Let's just talk about this latest report from the IEA. Are you surprised that we're getting a bit of a more bullish tone from the agency?
I think just to start out, as a macro shop at TS Lombard, our bias is to really look at underlying demand drivers in the economy. But we do have some expertise in oil producing countries, so we can look at supply side drivers as well. So we've always focused on demand, and that's been one of the reasons why we've had somewhat of a bullish view on oil markets for the past couple of months, even though it's been a little bit tumultuous from a geopolitical perspective. We have seen a bit of a price swing here and there, but really and truly, we think demand will be somewhat robust according to similar in line to what OPEC said in a couple of its reports, especially in September and October. So I think for the IEA, there's been a lot of talk of a supply glut that's sort of taken a bit of a back foot. And then this sort of increased demand and bullish demand view doesn't come too much as a surprise. It might come as a surprise in terms of the timing of the report. Obviously, I would have expected this to maybe come last month, but the data now, I think, suggests that there should be some demand growth on energy markets next year.
Does the demand growth stem primarily from China? Where are you seeing that?
Yeah, so if I was to mention, our China economist Rory Green and our EU economist Davide Onelia, we've got a bit of a bullish sort of view on European growth next year. We do see the German policy action and fiscal stimulus starting to show up and become visible in Q1 2026. And a similar type of story on the Chinese front. We feel like there's a lot of dry powder in terms of stimulus there, and that should be coming in post-Lunar New Year. And, we're a little bit more bullish on that demand front, and that just creates more demand for energy markets and oil.
Hamzeh, where does geopolitics, though, factor into this? And I focus in on some of the sanctions that we've been seeing more recently with Russia. Is that still at play when we talk about the narrative around some of the dynamics in oil?
Absolutely. And look, I think one of the main aspects of the recent sanctions that differ to previous sanctions is that, quote unquote, Trump has finally taken complete action against Russia in the sense that sanctioning the two oil majors, Rosneft and Lukoil, has had a bit more of an effect versus the tanker sanctioning, which we've seen, sort of play out over the past few years. Now, the argument on sanctioning has always been that there will always be workarounds and you'll always find a way to work around it. But this time around, it seems a little bit more effective and a little bit more sticky. Going back to your question about, geopolitical effects, I think that's mainly on the supply side. What we're seeing on the demand side is obviously the continued change in sentiment on the US-China escalation when it comes to the trade war. Although we're in a good spot right now, there's always, a tail risk of that going back negative. And we've seen the knee-jerk reaction oil prices have had in response to that sentiment. So that's something to keep an eye out on for sure.
And there's also, we just had a chart up about OPEC, right? And what potentially we get from OPEC. Could that potentially provide even more clarity in one sort of direction or another?
Yeah, I think OPEC are probably going to maintain their continued bullish stance, especially if you look at their previous reports. They've had quite a bit, I think it was around about 1.3 million barrels per day growth in oil demand versus the IEA's last report back in October was 700,000 barrels per day. So I think OPEC will probably continue to be bullish. They're also probably going to, look at the slowdown in the winter period for oil markets. Part of the reason why we think they, quote unquote, blinked on some of the supply cuts being unwound. So I think OPEC will probably continue to be bullish, and they've got a little bit more of a bullish demand forecast than we do. So that kind of falls in line with our views, but I think they will maintain course, especially when it comes to that difference with the IEA.
Hamzeh, let's just finish on prices, because right now we're looking at Brent is down just about 0.4% there. What is your expectation then now for what we see? Do we see continued downward pressure?
I think the only way we see continued downward pressure is if we get more negative geopolitical news. So if something were to happen in terms of the US-China trade deal, we keep feeling like it's getting to the finish line, but it's not there yet. In terms of geopolitical factors, the Middle East isn't, it's gone quiet now, so that's been priced out. It's mainly going to be what's going to affect supply. So any additional sanctions, maybe additional sanctioning on Iran after what we saw happen with the International Nuclear Agency. So keep all of those factors in mind. from a technical perspective, especially supply side, I think the supply glut story is sort of taking a back foot now. So in terms of prices, we could see continued downward pressure, but Chinese crude port inventory, although an opaque measure, has gone down. Same thing with the Bloomberg index on global floating crude. So, both of those going down is a bit more of a bullish sign. So there could be some downward pressure, but we feel like we've kind of gotten to an equilibrium.
All right, we'll see where prices go next. Thanks so much, Hamzeh Al-Gaaod, MENA analyst at TS Lombard, joining us there in London. Really appreciate your insights. Now, for a look at some of the other stories we're following this morning, the U.S. military is exploring whether to build a temporary base near the Gaza Strip to house 10,000 people. The move is seen as part of a stabilization force to monitor a ceasefire between Israel and Hamas. The Navy is seeking a cost estimate from pre-qualified companies for a temporary self-sustaining military base capable of supporting 10,000 personnel and providing office space for 12 months. Israel's Minister of Strategic Affairs, Ron Dermer, has announced he is stepping down after helping secure the release of most Israeli hostages as part of a ceasefire with Hamas. A former ambassador to the U.S., he also enjoyed close relations with the Trump administration and became a de facto liaison between the two countries over the hostage issue and when Israel and the U.S. struck Iranian nuclear sites earlier this year. And a Turkish prosecutor has requested a sentence of more than 2,000 years for the Istanbul mayor, Ekrem İmamoğlu. The indictment names 402 suspects and describes İmamoğlu as, quote, the founder and leader of a criminal organization with charges including bribery, fraud, and extortion. The court will have 15 days to decide whether to accept or reject the indictment. Coming up, the IMF issues a warning to African nations and beyond, saying they should tread carefully when considering swapping dollar loans from China into yuan to cut debt costs. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The International Monetary Fund has warned of rising currency risks for nations such as Kenya and Ethiopia that are swapping dollar loans from China into the yuan to tame debt costs. Kenya's conversion of Chinese railway loans into the yuan slashed its annual costs by $215 million, while Ethiopia is in talks to change at least some of the almost $5.4 billion it owes Beijing into the Chinese currency. For more, let's bring in Bloomberg's Ndiro Oganga, who's joining us from Kigali, Rwanda. So, Ndiro, what more do we know about some of these concerns raised by the IMF?
Good morning, Jennifer. So what the IMF is saying is that, in essence, while swapping debt, you could be solving one problem, you could be creating another problem in theory, all while acknowledging that swapping is an important mechanism and instrument in debt management. The main risk here is currency. You have dollar-denominated debt, you're swapping it into yuan. What it opens you up is to currency fluctuation risk. And so if the yuan gains against the dollar, then the cost of servicing your debt is going to increase. You also have to mold the economy around what's happening in China. The ups and downs are going to extend to you, and you're going to feel the trickle-down effect. So you need that flexibility to be able to absorb any shocks that are experienced in that economy. Another question that they raise is your reserves. Most of these countries hold their reserves in dollars. They'll have to build up their reserves to have enough yuan to be able to service these debts, and failure to which then they'll have to go back to the market and buy yuan, and then they're opened up to exchange rate fluctuations. But the biggest winner in this is China. For a long time, they've been trying to embed their currency into international commerce and payment systems. And so they're willing to absorb few losses here and there because of depressed rates back at home for as long as they get to rival the dollar.
And as we continue to see some of these trends take shape, though, across the continent, Ndiro, I wonder if some of this caution from the IMF is going to be enough to deter any of these debt swapping deals.
I think to understand that, we go back to the basics. One of the reasons that Kenya went for this debt swapping deal is one of the countries that is considered in high risk of debt distress. And so what they were doing is trying to ease short-term repayment pressures and also reduce the cost of servicing debt. And what Kenya has done a lot is reprofiling its debt. It's bought a lot of its international and domestic debt back to increase maturity period. And also, they've eased the cost of servicing their debt. We could say the same thing about Ethiopia that defaulted on its $1 billion debt. These are countries that are looking for relief. And to be honest, it looks like an attractive deal from the outside. Chinese rates are half what the dollar rates are. And also, Kenya says they've been able to save $215 million annually. But that is all they're saying. There isn't a lot of transparency when it comes to interest rate, maturity period, full repayment terms. And unless this can be made public and analyzed to ensure that the pros outweigh the con, then the IMF fears that if this deal goes wrong, then they become the fallback plan. And that's what they're trying to avoid.
Yeah, quite a bit to watch out for there across the continent. Bloomberg's Indira Oganga in Kigali. Indira, thanks as always for joining us. Now, for a look at some of the other stories we're following from the region, the IMF says it's explored several options with Senegal on how to tackle the nation's debt, but that it's ultimately up to the government to decide how it deals with the issue. An IMF mission wrapped up a visit to Senegal last week without an agreement on a new funding program. The West African nation's previous $1.8 billion package was frozen last year after the government disclosed hidden debts estimated at $7 billion. Nigerian stocks tumbled the most in 15 years as foreign investors rushed to sell ahead of a new tax regime set to triple capital gains taxes. The NGX All-Share Index fell 5% on Tuesday, the steepest decline since March of 2010. Africa's most populous country last month announced that foreign investors will face a 30% capital gains tax on the sale of Nigerian shares starting in January, up from 10% currently. And ArcelorMittal's exclusive talks with South Africa's biggest development finance institution on the potential sale of its local steel operation have ended without a deal, leaving the company free to seek other investors. An informal proposal of about $490 million from South Africa's Industrial Development Corp, made to the Luxembourg-based steelmaker, hasn't broken the impasse, people familiar with the situation said. Now, coming up, U.S. President Donald Trump's visa curbs have spurred a Wall Street hiring frenzy in India. We'll bring you our story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Major U.S. investment banks are speeding up their hiring of finance specialists in India. The flurry of job postings underscores Wall Street's growing reliance on Indian hubs. And that reliance is set to grow as President Donald Trump moves to tighten immigration by driving up visa costs. For more, we're joined by Bloomberg's Siddhi Nayak in Mumbai. Siddhi, thanks for joining us. And she's also one of the authors of The Big Take. Siddhi, can you talk about why India's global capability centers have become so important, especially for some of these U.S. banks?
Sure. Thank you for having me. Financial services firms as well as the banks based out of the U.S. have a significant employee base in India. The top 6 banks, the U.S. banks based in India, have employed about 150,000 of its employees in India. That's a significantly large employee base. The reason why these banks and financial services firms turn to India is mostly because there's a rising pool of talent that India has. India's demographics are pretty favorable, and there's a huge amount of talent that can speak and understand the English language. There is a lot of political stability in the country, and that is kind of luring these players to come to India and set up GCCs. JPM, in fact, employs 1/5 of its total employee base in India. We also have Goldman Sachs and Morgan Stanley that have employees more than that they employ in the US in India.
Wow, and just taking a look at some of the headcount there, that really underscores what you were pointing out there. Siddhi, can you speak to what we're seeing in the U.S. and some of the visa curbs from President Trump and potentially how that plays into expansion plans of some of these banks?
Sure. So traditionally, India's GCCs were viewed as call centers. Most of the back-end jobs were done from here. But now we can see the scenario completely changing. Right now, Wall Street banks and financial services firms mostly use their Indian GCC counterparts for high-end tech and financial-related jobs. So that is a big change. Now, with Trump's imposition of the dollar visa fee, rather, we've seen more sophisticated high-end jobs coming back to India. Our sources indicate that most of these Wall Street firms and banks basically are looking to hire more talent inwards. There is a growing need for, high-end specialist roles coming out from tech as well as the financial space. That's ultimately going to feed into India's revenue potential as well as boost the GDP growth in India.
Really fascinating story there. Bloomberg, Siddhi Nayak joining us. Thanks so much, Siddhi. And you can read this story from Siddhi and her team and all of our previous big takes on the terminal. Just type NI Big Take Go and on Bloomberg.com. Now, let's just take a quick check at your markets right now. As you can see, a bit of green on the screen right now as far as U.S. equities go, as well as potentially a bit of upside there in Europe, at least in the U.S. That's softer than expected. ADP report potentially indicating Fed rate cuts are on the table in the near term, potentially in December and beyond. But that is it for Horizons Middle East and Africa. I'm Jennifer Zabasajja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.